Hello everybody, we're Group 3 from the Theory of Macroeconomics class, and today we would like to show our video discussing fiscal and monetary policy. Do you know what fiscal and monetary policy are? Or have you ever thought about how the Indonesian government deals with unemployment and inflation? Or maybe, are you curious about the influence of the amount of money circulating in society and how to control it? To answer your burgeoning questions, let us get on with the video. To start off the discussion in this video, let us start with a simple question. What is the definition of fiscal policy itself? According to Indonesian economist Sadono Sukirno, fiscal policy is defined as the steps that a government takes in order to create change in the taxation system and/or government spending with the intention to address the economic problems that are encountered. Fiscal policy itself has a role in a three-sector economic system. The three-sector economy can be interpreted as an economy consisting of the household sector, the corporate sector, and the government sector. The existence of the government sector allows us to analyze the roles of the government in that of influencing economic activity. In a three-sector economy, the following equations apply. The first equation describes the aggregate supply as represented by national income, Y, is equal to aggregate expenditure, which includes household consumption, C, corporate investment, I, and government expenditure on goods and services, G. The second equation describes a situation where the injection size is the same as the leakage. The injection in question is in the form of corporate investment, I, and government expenditure, G, while the leakage is the sum of savings, S, and taxes, T. Through fiscal policy, the government can manipulate the amount of government spending and/or the amount of tax in order to influence the current balance in order to create the desired new balance. Based on the definition of fiscal policy, its existence has the aim of overcoming the economic problems faced by a country. In a three-sector economy, two economic problems that are often encountered are unemployment and inflation. Thus, the next step will be to discuss the efforts that can be made by the government to overcome the problem of unemployment and inflation through fiscal policy. When the economy is facing an unemployment problem or crisis, the actual aggregate spending, AE, is below aggregate spending at the full employment consumption level, AE sub F. In addition, the value of actual national income, Y, is less than the potential national income, Y sub F. The line AB is called the deflationary gap. The deflationary gap can be interpreted as the magnitude of the shortage of aggregate spending needed to achieve full labor consumption. To overcome this, the government needs to increase aggregate spending so that the level of economic activity can develop and unemployment can be reduced. Steps that can be taken to increase aggregate spending are to increase government spending and/or reduce tax collection. This action can lead to a budget deficit, in which expenditure is greater than income. When an economy is facing the problem of inflation, actual aggregate spending, AE, is above aggregate spending at the full employment level of consumption, AE sub F. In addition, the value of actual national income, Y, is more than the potential national income, Y sub F. The difference between AE and AE sub F is called the inflation gap, and it can be interpreted as the magnitude of the excess of aggregate spending from aggregate spending at full labor consumption. To overcome this, the government needs to reduce its aggregate spending so that the level of economic activity can decrease and inflation can weaken. Steps that can be taken to reduce aggregate spending are to reduce government spending and/or increase tax collection. This action can lead to a budget surplus, where income is greater than expenditure. In the long run, the application of fiscal policies can reduce the constant up and down of economic activity from time to time. This influence is illustrated by the corporate cycle chart below. With fiscal policies, the ups and downs of economic activity can be reduced. Thus, if there came a time when there was a serious problem of unemployment or inflation, the presence of fiscal policy would be able to alleviate the problems that occurred. Next, we are going to talk about discretionary fiscal policy. Discretionary fiscal policy is defined as steps the government takes in order to change its spending and/or tax collection with the aim of reducing the up and down movements of economic activity from time to time, and creating a level of economic activity that reaches a high level of labor consumption, does not face the problem of inflation, and always experiences satisfactory growth. There are three forms of discretionary fiscal policies, that is, change only government spending, change only the tax collection, or change both government spending and the tax collection. Discretionary fiscal policies that can be applied to address the issue of unemployment include: maintain taxes and increase government spending, maintain government spending and lower taxes, increase government spending and lower taxes, or increase both government spending and taxes by the same amount. Meanwhile, the discretionary fiscal policies that can be applied to address the issue of inflation include: maintain taxes and reduce government spending, maintain government spending and increase taxes, reduce government spending and increase taxes, or reduce both government spending and taxes by the same amount. Next, we are going to discuss about the ways that the Indonesian government have implemented fiscal policies in handling economic crises. First, when facing hyperinflation rates of 500% in 1966. During the reign of President Sukirno, Indonesia was rocked by a financial crisis. This crisis caused a case of hyperinflation which was marked by a very high inflation rate, in the range of 100% or more, in 1961. The peak happened in 1965, where the inflation rate at the time exceeded 592%. To overcome this problem, the Ministry of Finance of the time initiated a comprehensive economic stabilization program called the Stabilization and Rehabilitation Policy Package. Of the 4 policies contained in this package, there was the disciplinary fiscal policy and balanced budget. This policy emphasizes saving on government spending and subsidies, where the budget issued by the government cannot be greater than its income in order to reduce the deficit. In this case, the discretionary fiscal policy implemented by the Indonesian government is to maintain taxes and reduce government spending. Secondly, in anticipating increased unemployment during the COVID-19 pandemic. At the start of the COVID-19 pandemic, the unemployment rate in Indonesia increased. Before COVID-19, in 2019 the unemployment rate was 5.28%. But, in 2020, the unemployment rate rose to 7.07% due to the large number of layoffs and businesses that went out of business due to the impact of the pandemic. In order to reduce the impact of COVID-19 on the employment sector, President Joko Widodo set 6 strategic policies. Among the policies, there is a fiscal policy in the form of an economic stimulus package for businesses to avoid layoffs and an intensive income tax for workers. In this case, the discretionary fiscal policy implemented by the Indonesian government is to increase government spending and reduce taxes. Now, after listening to the informative little description regarding fiscal policies, it's time that we satisfy your curiosity concerning monetary policies and explain furthermore on how they operate. First off, let us learn about the definition of monetary policy itself. Again, according to Sadono Sukirno, monetary policy is defined as the measures a government implements by the central bank to influence the money supply in the economy or change interest rates, with the intention of influencing aggregate spending. The main objective of monetary policy in Indonesia is to ensure stability in the value of the rupiah. In meeting this main goal, many aspects will be affected. Some of the objectives of monetary policy are ensuring economic stability, control inflation, increase employment, and keeping the international balance of payments stable. There are 2 types of monetary policy that are commonly used. These 2 types are expansive monetary policy and contractionary monetary policy. First, let's talk about expansive monetary policy. Expansive monetary policy is a type of monetary policy that carries out the management and circulation of funds in economic activity. The main objective of this type of monetary policy is to increase the circulation of money in society so that economic activity increases. One of the forms of this type of policy is the purchase of securities by Bank Indonesia, the reduction of interest rates, and reducing the reserve requirements for banks. Next up is contractive monetary policy. Contractive monetary policy is defined as a monetary policy that is taken as a step to reduce the circulation of money in society when inflation occurs. One of the implementations of this policy is the sale of government bonds, the increase of interest rates, and increasing the reserve requirements for banks. Generally, monetary policy has its main variables, namely the unemployment rate and inflation. However, there are several other monetary policy instruments that are: A. Discount policy or discount rate. This is the condition in which commercial banks borrow funds from Bank Indonesia in order to stabilize the circulation of money. If the money supply increases, the interest rate will be increased. Vice versa, if the money supply decreases, interest rates are lowered. B. Open market operations. The government also wants to control the circulation of money through the sale or purchase of government securities. When the circulation of money wants to be reduced, the government will sell these securities. If the circulation of money wants to be increased, the government will then buy these securities. C. Mandatory reserve ratio policy. When Bank Indonesia wants to reduce cash reserves, then they will reduce it in the form of loans. Meanwhile, if Bank Indonesia wants to increase cash reserves, the circulation of money in the community will be withdrawn by increasing loan interest rates. D. Determination of reference interest rate. To fulfill the objectives of monetary policy, Bank Indonesia has the authority to determine interest rates. The interest rate set by Bank Indonesia will then be the reference interest rate for other banks. E. Moral appeal. In order to implement monetary policies evenly, Bank Indonesia must provide moral appeals to other banks in order to implement policies to increase or decrease bank interest rates. Now, we are going to discuss about the examples of monetary policy in a few countries. Firstly, let's talk about how Indonesia implements monetary policies. Through Bank Indonesia, Indonesia describes monetary policy in the following policies, which are under the umbrella of one major policy called the Inflation Targeting Framework or ITF. ITF is a framework with a monetary policy directed to achieve the inflation target that is set in the future and announced to the public as a manifestation of the commitment and accountability of the central bank. Here are the programs that the ITF implements. A. Direct credit implementation by Bank Indonesia, in which Bank Indonesia directly lends credit intended for sectors or projects that require these funds urgently. By implementing this, it can help increase the money supply. B. Provision of overdraft facilities. Overdraft facilities are assistance or loans to commercial banks that are experiencing difficulties in funding. The assistance that is provided is in the form of a short-term loan with a high interest rate. This will certainly increase the stability of money circulation. C. Issuance of government bonds. In this case, the government is attempting to raise public funds so that the funds circulating in the community will decrease. D. Rupiah Intervention Program. The Rupiah Intervention Program is a policy of Bank Indonesia in the form of a process of borrowing funds directly on the interbank market within a time span of 7 days. This is a step to support the instrument of open operating market activities. Next, we are going to talk about how Japan implements monetary policies. In Japan, the Bank of Japan, or BOJ, determines and implements monetary policy with a target of maintaining price stability, an inflation rate of around 2%. They face various battles, such as low economic growth, low inflation rates, and bad bank debt. The BOJ has tried various measures, such as quantitative easing, QE, quantitative and qualitative monetary easing, QQE, negative interest rates, and yield curve control. Due to the fact that some of these actions did not reach the 2% inflation target, the BOJ created a new formula, namely the quantitative and qualitative monetary easing, QQE, with yield curve control, YCC, to achieve the 2% target in inflation. The BOJ decided to introduce QQE with yield curve control by strengthening the two previous policy frameworks mentioned above. The new policy framework consists of two major components. The first is yield curve control, in which the bank will control short-term and long-term interest rates, and the second is an inflation overshooting commitment, in which the bank commits itself to expanding the monetary base until the year-on-year rate of increase in the observed consumer price index, CPI, exceeds the price stability target of 2% and stays above the target in a stable manner. Now, we have reached the end of our video. Certainly, all your feelings of curiosity have been answered. We would like to thank you so much for following us through our journey in traversing the world of fiscal and monetary policies. We hope that this video has helped you in understanding a little bit more about the subject. See you next time.